Hello guys, welcome to a new deep value video. Today we're going to analyze Ferguson Enterprises, ticker symbol FERG. As always, we'll break down the company's key financial metrics and, by the end, aim to determine its acceptable buy price. Ferguson is a US distributor of plumbing supplies, PVF, waterworks, and fire and fabrication products. It is also a major distributor of HVAC equipment and industrial products and services. As of the 16th of September 2024, the stock price stands at $193 and it has a market cap of 38.8 billion. Moving on to some key valuation metrics, the company's price to earnings ratio is 20.3, while its price to cash flow ratio is 15.9. Now let's take a closer look at the company's growth rate over the past 5 years. We can see that its revenue has grown by 50.7%, while its bottom line has increased by 70.4%. In terms of earnings per share, there has been a growth of 103.1%. However, it's also important to note the change in the number of common shares outstanding, which stands at 204 million, reflecting a minus 11.9% change. Additionally, the interest coverage ratio is 14.5, suggesting the company's ability to meet its interest obligations comfortably. Next, let's move on to the balance sheet, starting with the quick ratio, which is calculated by dividing current assets minus inventory by current liabilities. We see that it stands at 0.94. This ratio helps us understand the company's short-term liquidity position. Looking at the long-term debt-to-equity ratio, we find it at 0.63 and the overall debt-to-equity ratio at 0.73, both being at very good levels and signaling a low debt load. Now let's transition to the cash flow statement. Cash from operations is 2.7 billion, reflecting a change over the past 5 years of 110.8%. Meanwhile, cash from investing activities is minus 1.05 billion, showing a change of 34.6%. Furthermore, cash from financing activities is minus 1.8 billion and has changed by minus 1,480% over the same period. CapEx has also grown by 47.9%. And lastly, free cash flow has grown by 78% during the same time, from 920 million to 1.64 billion, and is projected to grow to 1.8 billion in fiscal year 2025. Moving forward, let's look at the return metrics to see how the company is utilizing its resources. The return on equity is 45%. The return on investment is 29.3%. The return on assets is 11.5%. And the return on invested capital is 9.2%. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis by using a discount rate of 10%, a revenue growth rate of 4% for 10 years, and a perpetuity growth rate of 1.5%. We get a fair value of $118.6. Secondly, using a multiples valuation of 20 times trailing 12 months earnings, operating cash flow, and 25 times trailing 12 months free cash flow, we get a fair value of $201.1. And thirdly, the analyst price target is $234.6. Putting it all together, we get an intrinsic value of $184.8, and using a 15% margin of safety, we get an acceptable buy price of $157.06, suggesting that the stock at the current levels is slightly overvalued. To wrap up my analysis, I rate Ferguson as a hold. Personally, I would consider investing in it only if its price dropped to sub 150 levels. Thank you for watching. If you found this video helpful, please like and subscribe for more deep value analysis. See you in the next video. Bye.